Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and we just wrapped up part 2 of our interview with Lloyd Ippolito, CPA out of New York. And today what we talked about are some of the potential changes that may be happening to the tax code for this upcoming year.
Now, normally, Cameron, you know me, I'm excited about something like this.
Very, yeah.
And I say I was excited leading into it. But when Lloyd started sharing all these points, not a lot of positive news.
No,
I would say. But that being said, I think it makes this podcast even more important, right? Because whether there's good news or bad news, it's just news. I mean, these are some things that we need to deal with. And when we learn about them, we can be in a better position to take advantage of them.
Yeah.
I will say one thing that I was shocked, like floored to hear some of these rules or these tax laws had nothing to do with tax. What it did have to do is limiting our choice, which I'm not a big fan of. And I know that hit home for you. So I don't want to take any more of your thunder like I normally do. But what were some of your takeaways, Cam?
Well, same thing. I mean, I think it's really hard to listen to this podcast and not realize that there is some sort of control that's being taken away from people in regards to retirement. And so I think that the takeaway from this is really the idea of taking back control of your retirement and then finding those opportunities, investing in things that you know. So again, main theme for me is going to be control. Take back some of the opportunities that are out there and available to you right now.
Enjoy the episode.
Take care. Lloyd, we're excited to have you here today joining us. We look forward to talking about some of the changes we've got for the upcoming year and maybe some planning that we can do. But first, if you would, give us a little bit about your background, man. CPA, tell us kind of how you got here.
All right, Cameron, Anthony, thanks for having me. Well, as a CPA, I first started out, I'm the son of two accountants. My mother's an accountant and my father was a CPA. I was always helping him out in his business when I was younger, wherever I could. Mm-hmm. And I just gravitated more and more towards learning what he does. He was the VP of tax for large Fortune 500 companies during his career, eventually opened up his own practice in the early 2000s. Learned a lot from him and, took a slightly different path. I started out more so out in public accounting, out as helping out clients at all levels of their investing journey. Mm-hmm. Our firm recently received certification from Tom Wheelwright's Wealthability Network. So I'm proud to say we're a Wealthability certified member.
Nice.
And we specifically focus on entrepreneurs and using the tax code as a tool to help them build their wealth.
Like that.
Love to hear that.
That'll be a good transition into maybe discussing some of the changes that we've got planned or potential changes in the tax code for this upcoming year.
No, absolutely. And, we're trying to keep an eye on everything as best we can. Of course, what's always the issue when you're looking at things like this, and it was the same case when we had the Paycheck Protection Program loans last year. Mm-hmm. It's half this stuff is never finalized, and even when it is finalized, it's still going to be open to interpretation for quite some time. Mm-hmm. So one of the biggest changes is basically how they're going after these high income earners. And there's a different threshold of high income for each of these provisions in the tax bill. We now have our 39.6% bracket reintroduced. That's going to be anybody over 400,000 single, 425,000 has had a household, and 450,000 married filing jointly. So they'll pay 39.6% on their marginal income above those limits. Going along with that, slightly different thresholds. Again, we have the net investment income tax, which was previously an Obamacare era tax, 3.8% on interest, dividends, rents, etc. Now what they're doing is they're expanding it to basically account for all income that's not wages and not income subject to self-employment tax. So that means that now you have a business, you're a material participant, and you're in an S corp. You previously were not subject to that 3.8% surtax, but now you are.
Now,
That's
Lloyd,
based off.
is there a threshold when that begins, or is that for everybody?
Nope, just about to say it was 400,000 single, 500,000 married filing jointly are the thresholds for those.
Okay, what I
So
think is,
same thing.
wait, Lloyd, so you're telling me that the government created this tax just for investment income or just certain things. And now you're telling me that they're changing it where that tax is going to include more sources of income? That doesn't sound like our government.
They wouldn't do that.
No, that's
Okay.
correct, Anthony. And you and I both know that when we talk about these things like government sponsored daycare, it all comes at a cost from somewhere.
Mm-hmm. Yeah. Okay. So what are some of these other changes, Lloyd?
For anybody who's has capital gains and is in those in that 39.6% bracket, that capital gains rate goes from 20% to 25%. Now, this is one of those changes that's retroactive till September 13th of 2021.
So so the capital gains rate for them went up from 20 to 25. Now, will
Correct.
that also be subject to the investment tax as well?
Yes, it will. So in effect, the 25% is a misnomer. It's really 28.3%. Excuse me, 28.9%. 28.8%. I'm sorry.
And then that's federal. And then if you live in a great state of New York or California, like you do, Lloyd, you get the honor of paying even more.
The privilege.
Okay, awesome.
Privilege, yes.
Lloyd, so far these aren't sounding good. So I'm hoping you got some good news for us.
The good stuff for last.
Yeah.
Well, the good news is unless you're strictly a W-2 employee, there's something that we could do for pretty much everyone. One of the
if you say 401k, Lloyd.
Sorry?
If you say max fund your 401k, Lloyd.
Anything but. So part of the benefit I get from Wealthability as a professional is we also have a network of like-minded CPAs that have the same idea of helping people take advantage of trying to lower their tax bill. And one of the other opportunities that's in place, it's actually a remnant of the 2017 tax bill, which, as you both know, that was anything but bipartisan, but this provision had strong bipartisan support, and it was called qualified opportunity zones. And one of the opportunities of investing in a qualified opportunity zone, it's actually a three-part benefit. One of which is taking a capital gain. For example, say you sold $300,000 worth of Tesla stock, and you have a $300,000 gain. That $300,000 gain, you're able to take that, invest into a qualified opportunity zone fund, and defer your capital gains bill until 5 years out. So you're talking about 2026 and paying the tax on that in 2027. Then you're going to get a stepped up basis on that stock and will knock 10% off your gain. And you'll basically have that until the fund liquidates. And at which time, when the fund liquidates, your gain on the investment's eliminated, on the investment in the opportunity zone fund.
So what I'm hearing, that you can defer the capital gain, the original capital gain, and pay it 5 years later?
Correct.
And it'll be 10% less?
Correct.
Okay. And then any gain derived from the new investment is tax-free?
Yep.
Interesting. Okay. All right, Lloyd. Okay, good. And we're back. We got some good stuff.
A little sliver of sunshine there, Lloyd. Thank you.
So is that only for capital gains?
Correct. You could only use it based off capital gains.
Okay. Lloyd, I know we're going to talk a little bit about cryptocurrency. Now, when somebody trades crypto, is that capital gain or ordinary income?
Well, until we get into the whole angle, whether somebody's doing it as a trader versus they're just doing it as a relatively passive investor, let's say, that's going to be capital gain.
It will be capital gain. Okay. All right, cool. Okay. Because sometimes,
It's a little less clear when you're talking about business property and whether it could be 1231 gain.
Okay. But if somebody's just buying a little crypto and holding on to it, and if they hold it for more than a year, it'll be a long-term capital gain.
Yes.
Okay, perfect. So this opportunity zone could be something that they can use to offset the gain from crypto. Is that?
That's correct.
Okay. Okay. All right.
Good to know. Good to know.
All right. What other
Yep.
new great news you have for us, Lloyd?
Anybody who's interested in green energy, you have the opportunity for solar panel installation. They're increasing that tax credit. It's currently at 26% and set to sunset at the end of 2023. It's now extended until 2033 and is increased till 30%.
Oh. Okay. Oh. Okay. There's something good.
Yeah.
All right.
We went through an interesting scenario where somebody could be in the 40% tax bracket, and Cameron, like you said, they could be paying an additional 13% or so to the People's Republic of California, and installing these solar panels on some property, possibly where they have their office, for example, and not only getting the tax credit. What's interesting too is your tax credit is still not entirely a decrease in the basis of the property, which means that you could still get bonus depreciation on about 85% of that property. And especially if you're using some sort of financing option, it's possible your tax benefit overall will exceed your down payment for that solar loan. And then everything else that you have as far as making those solar payments is just in lieu of paying a power bill.
Lloyd, I think the best thing that you just said was that I think it's funny that you're from New York are throwing shade to the people in California. That's ironic.
I always say we're not much better, but we're still better.
Okay, awesome. Okay, I like that. What else you got?
One other limitation for individuals who have syndications and any other type of assets in their IRAs, the Congress has indirectly, they haven't specifically thrown out accredited investor. They're basically referring to any investment that requires minimum income assets or education can no longer be held in an IRA. Doing so is considered a prohibited transaction. They're basically giving people until 2024 for people who already have these assets in their accounts to get them out of the account, sell them off, and replace them with some other assets. Now, depending on the type of syndication, that might not necessarily be a bad thing. We're proponents of not having tax shelters like real estate inside another tax shelter like an IRA. And Anthony, I know you've discussed this too on your on other podcast topics, but real estate really does not belong inside a retirement account because you lose those tax benefits like depreciation that make it such a great asset to begin with.
Okay, Lloyd, but just to clarify, what I'm hearing is, because I know we have a lot of clients that are like a syndication. Cameron, a syndication is when somebody's raising money, like maybe they want to buy an apartment complex, but maybe you don't have 30 million, but so they do a syndication and then they create an LLC and they raise money and you buy shares in the LLC, which I know that's very popular now. And what happened is a lot of people, they want to invest in those, but the money's tied up in their IRA. So they're using a self-directed IRA to invest in those. But what you're telling me is that by 2024, they can't own those. Right? Now, is that law or is that what's in the new bill? That has
This is what's in the new bill. So as of the date we're recording this is not established law.
Okay.
It's something that's we consider strongly likely to pass in its current condition.
Okay. What my concern is, if somebody has one of these investments now, or maybe they're considering going into one of these investments, I'd be a little bit more hesitant because I don't know what their exit strategy is going to be for you. You're going to have to get out. I don't know.
And it can be very difficult to get out.
Yeah, that's one of the downsides of the syndications are the lack of control. So if that would be a concern of mine if you own a syndication or considering owning this. But Lloyd, here's a question. What is limiting these investments inside an IRA? What does that have to do with raising taxes?
It's not necessarily raising taxes either. Yes, you certainly have the angle that um, the governments have it out for the retirement plans. It's their money they see as being trapped in some of these vehicles, and they want to get it out so they can tax it. But I think the other thing you have to consider, and it's evident whenever you're reading through this bill, how there are favored groups of a given party in power. And in this case, this is just a nod to Wall Street. Because if people can't put their money in syndications, where are they going to put it? They're going to put it back in the market.
Lloyd, you stole my thunder, man. That's to me. Look, not that I agree or disagree with this bill, but I know they're trying to offset the expenditures, which I do appreciate. But by limiting the choices America has with their investment dollars has nothing to do with raising taxes. It's more of a control, and it's making it harder for the middle class to invest in some of these alternative investments. It's like, it's kind of Wall Street or nothing is really what they are pushing. So just another jab at qualified plans. We're giving up control. And here's a prime example where the government is making changes, taking away your control. And I mean, at least grandfather people in. So people might have had one of these investments for a few years, 7 years or 8 years, but then now they need to liquidate or make a change. It's just frustrating.
Well, and that's their idea, as limited as it may seem with them grandfathering it in. They're at least giving you a couple of years to take action. Now, the other problem is this is still going to be open for interpretation. What does that mean? Well, does this mean they have to sell the assets and keep it in the IRA? Does this mean they're going to be allowed to take it out of the IRA without penalty? Their regulations are going to need to be written for this to see how we're going to go about an exit strategy for these people.
Okay.
And just another knock as far as accredited investor to begin with, because that's basically the government saying that you're not worthy to invest in these type of assets because we don't think you have the education, the experience, which, again, that just kind of puts it back in the Wall Street casino.
Well said.
Yeah. Awesome.
Keep swinging, Lloyd. I like it.
Yeah.
Nelson Nash basically says through his book, he says everybody needs to be in two businesses. Banking, yes, but the primary idea is the business you're in. And if the business you're in is one you're good at, which I hope you are, then you're going to develop that expertise to be as sophisticated as you need to be in your business. It's, accredited investor status shouldn't matter as far as making money. That's basically just going to be strictly a knowledge test.
Nice.
Anybody can make money in any asset class.
Yeah.
I like that, Lloyd.
Okay. What else you got, Lloyd?
Well, again, still as we're taking hits on qualified plans, employers that are offering qualified plans, you pretty much knew that, employers were taking advantage of auto enrollment provisions, which basically gave employees a deadline in which to opt out of contributing to a qualified plan like a 401k. And if they didn't, then they would just be auto enrolled and contributing some default percentage of their salary and put in some default fund, usually a target date fund based on their age. Now we're going a step further and saying it's no longer employers have the option. They're required to have people automatically enrolled in their qualified plan with a massive penalty if they don't. It's $10 a day per employee.
Dang.
Is the penalty for failing to have an auto enrollment procedure.
Wait, man. So do you have to have a qualified plan if you have more than 5 employees? Right? What if you don't have a plan?
No requirement to institute a plan, but this makes me a lot less incentivized to institute a plan for employees. If I were an employer, I have to say, to know that there's another regulatory burden you have to deal with.
Oh, absolutely. From the employee's point of view, man, is Somebody's making that decision for you. I'm not a fan of that, obviously.
No, I mean, man, again, the control, and now they're pushing more and more people into these 401ks. They're pushing them in. People aren't investor. I mean, I know we kind of, maybe we do bash 401ks in the market, but
yeah, we do.
It's not necessarily, and the reason being is that we believe an investor should be knowledgeable and know and do their due diligence, have their education. And the 401k, there's no education requirement.
No education. There's no influence you can put into that investment to make it perform any better. It's
interesting. So now they're turning people who have no experience, no education into an investor in the stock market. But then you have people who are accredited investors, right? And now they're limiting the people that supposedly have the high net worth and the experience. They're even limiting the experienced investor in what they can do. Okay. All right, Lloyd, what else you got?
For what it's worth, sometimes there's should be a requirement that people take some sort of basic business test in order to even start up entities. We get in people time to time, they start up a corporation, they have no idea what to do with it. And then they come around to us, yeah, I haven't filed a return for this thing ever. I didn't think I needed to. And we say to them, well, this is a partnership. There's a $195 per partner per month penalty instituted for failure to file the return. And, sometimes, again, we could go for abatement for a first-time filer, but sometimes it's multiple years, and sometimes they really just had no income. So I think I'm all about the idea that people get educated in whatever they're doing, as far as whether it's starting up their own business or the type of investments they run into.
So what other new great changes? What other good news you have for us, Lloyd?
So this is a potentially positive change for some of the people on the lower end of the spectrum income-wise. Probably not so good for the large companies out there. Right now, for the C corporations, we have a flat 21% tax on all income on the federal level. We're going back to having a set of graduated tax brackets for those corporations. So that's going to be 18% for any corporation with under 400,000 in income, 21% between 400,000 and 5 million, and 26.5% for anything over 5 million, which certainly makes us less competitive on the global scheme as far as our tax rates are concerned. But that is a potential planning opportunity for anybody that's under 400,000. That 18% looks even better than it was before as far as using C Corps in our entity diagram. So, Anthony, Cameron, the way we do a lot of things here under the guise of wealthability, we're a big believer in using multiple entities and using multiple entities for the right purposes. So it's not unusual for us to introduce C corporations, S corporations, and LLCs as partnerships in some way, shape, or mix. C corporations are great. They have these set of graduated tax brackets, and anytime you have another set of tax brackets, that's the planning opportunity right there. You also have the opportunity to set up certain tax-free fringe benefits, a health reimbursement arrangement being one of the most common ones, which I like to refer to as a flex spending on steroids, because you don't have if you do it right, you don't have your annual limits that a flex spending does. You don't have a use it or lose it provision. It's basically a way to convert a non-deductible expense like your medical expenses into something you can deduct as a business expense.
I would tell you, if somebody has a lot of medical expenses, unfortunately, that's me with our family. Having that dual entity, having that C Corp is allowing us to deduct literally 100% of our medical expenses with no cap. Like, Lloyd, this is a prime example of reasons to get educated and working with a proactive CPA. A lot of times people will, I just do the taxes myself, or my buddy or my uncle, and they probably can prepare the taxes, right? Preparing the taxes is one thing. To me, the biggest benefit is getting some experience and being proactive. Should you have an S? Should you have a C? Should you have both? And what is great about with Wealth Ability and what Lloyd's doing is they're going to go through and explain the pros and cons of having both or multiple entities. So I think a C corp is great if you have a lot of medical expenses, and also if you have a child in college. There's some great tax advantages there as well. Okay, Lloyd, what else you got?
Just going back to entity structure. Again, education is very important. Tax prep in and of itself is just becoming more and more of a commodity. It's a question of we don't want to compete against TurboTax and H&R Block. We want to compete against big four accounting firms that are doing tax consulting at a premium.
Mm-hmm.
And our idea is to make it affordable for mid-level entrepreneurs, and again, be able to give them holistic financial advice. And whether that's, just in reference to the fact of, hey, maybe you should be doing some personal bookkeeping yourself and see if we have the opportunity to take expenses that you're already shelling out for and making them business expenses. Again, similar to medical, some of the simplest deductions out there, the home office and the auto expenses, are ones that often aren't taken advantage of. Well, why not? You're already spending the money for it. Why not get some tax benefit for that? And really, the reason people don't take advantage of it comes down to poor record keeping.
Yeah.
A lot of people just don't follow the requirements. They're not knowledgeable of what needs to be done in order to make sure they can take advantage of all those benefits. Tom Wheelwright is famously known for saying that the tax code is a series of incentives. And the idea is just making sure we take advantage of them and do the best we can for our clients. Tom shared with us after he got back from the National Tax Seminar in D.C. A couple weeks ago, when Commissioner Chuck Rettig presented there. He basically referred to each of the individuals in the room as part of the tax administration. And Tom's approach was, no, we're not part of the tax administration. Our objective is to do the best for our clients. It's not to help out the IRS. As Rettig goes on to say, well, you guys need to be more patient with us. Yeah, so what? We can't answer half the calls that come in. That's not our fault. You need to work with us. Anthony, what happens when a private sector business fails to provide good customer service?
Oh, they're not coming back.
Yeah, you go to business.
Yeah,
in a hurry.
No, absolutely. Now find me somebody who's going to compete with the IRS.
I wish we could.
Yeah.
We could do a lot better job. People would like us better.
Yeah.
Right?
We'd like you better. Yeah.
Okay, Lloyd, what other goodies you got for us?
Cryptocurrencies. So one of the, I guess I'll call it a loophole that existed with cryptocurrencies. The government always came along with the idea that we're going to tax this as property. And the reason that's relevant is cryptocurrency in a way functions more like a security. If you buy Bitcoin, you're not buying a specific serial number of Bitcoin. In a sense, you are, but they're pretty much all interchangeable. Versus, say, for example, you buy a commercial building, you sell it, and you buy the one across the street. You are buying two separate properties. Now, the reason that's relevant is because of what are called the wash sale rules. Up until now, what's kind of been the unwritten rule is that you could be able to sell if you had a loss right now on Bitcoin, if you were to sell it right now and buy it back, you could take advantage of that tax loss. And when you rebuy it, you have a lower basis, but so what? You got advantage of that loss deduction. Well, now they basically wised up to that, and they're going to make cryptocurrencies subject to those called wash sale rules, which basically mean that loss is, instead of being allowed, it's going to be disallowed and added back to your basis, which will decrease your gain when you go to sell it again for what would theoretically be the final time. Now, those wash sale rules apply to when you're selling some sort of security, now whether it's Tesla or whether it's Bitcoin, and you buy it back again within the previous 30 days or within the following 30 days.
What are the dates that is scheduled to go in place? Is that retroactive to any date? Is that a planning opportunity there?
Nope, that is in for next year,
Okay.
2022.
Okay.
And it sometimes has been thought as a bit aggressive because nobody was sure of what the IRS interpretation is. This to me seems to be evidence that the Congress's interpretation certainly wasn't law before, but it is now. Otherwise, they wouldn't see the need to make this a revision in the bill.
Gotcha. Okay, what else you got, Lloyd?
Did I talk about the $10 million limit on the retirement accounts?
Not yet.
Wait, a limit on how much we can have in an IRA? Do tell, Lloyd.
Yeah, so they're now imposing it, and it's across all plans, across all accounts, custodians, however you want to label it. It's a $10 million limit on your total value of your qualified plans. Now, interestingly enough, this is only in effect for, again, here are our magic numbers: 400,000 single, 500,000 married filing joint, as far as what they're limited to having in these accounts. Now, to me, that means, and this is going to be important to us for planning too, you could have somebody with $20 million in an IRA as long as their income is less than $399,000.
Okay, so Lloyd, what I'm hearing is if you have more than $10 million in all your qualified plans, so that would be IRAs, SEP IRAs, 401ks, would it also include a Roth?
Yes, it will.
Okay, so it's going to include all of those. Okay.
Correct.
So you can't have more than $10 million. Is it only if you make a certain amount of income?
Correct.
Oh, okay. That part.
400 is the magic number, right?
Okay.
400 single, 500 married filing joint.
Okay, so what happens if you already are above the 10 million, or if you get over it in the next couple of years? What happens?
So basically, it's a new required minimum distribution calculation that's in place. And once the balance is over $10 million, there's a required minimum distribution that 50% of the balance in excess of $10 million must come out within the next year.
Okay, if you take that out, that'll be taxable? I mean,
it's getting thrown on top of the 400 or 500.
Yeah.
Right. Now, interestingly enough, they will be excluding that required minimum distribution for purposes of determining whether you're over the 400,000.
That makes sense.
Okay, what about the net investment tax? Will you pay that on top of of this distribution in addition to
theoretically
income?
Yes.
Okay, all right. What happens if? Go ahead.
What's interesting about the way they wrote this, and I think that's kind of just more so evident that they don't want people having money in Roths as opposed to their need to collect revenue. You actually have to collect it has to come out of the Roth accounts first once the aggregate balance exceeds 20 million. And once it exceeds 20 million, you have to draw from the Roth accounts first to the extent that you have depleted the Roths or the balance is under 20 million. Whichever is less. So it's fair to say that they don't want too much of that income being perpetually tax-free.
Yeah. Which is the exact opposite of the way we typically will run distribution strategies.
Right. Yeah. Just see how this is more of a controlling issue, right? Yeah. And
they're dictating where you can put it, how much you can put it, and when you'll take it out.
What I think is interesting, they're going to let you grow that money tax deferred, right? Because they know that as that grows, and taxes go up, that they're end up making more money, taking the money out of your IRA eventually.
It'd be interesting to see how big that projected tax would be as far as the number of people that would maybe affected by that at $20 million.
And here's something else. You hit the nail on the head when you're talking about taxing at a higher rate, because not only is it going to compound, we don't know what the tax rates are going to be 10, 20 years from now when we go to take that money out of the account.
I got an idea. It's going to be higher than what it is today. It's going to be more. Yeah. Dang.
But just like you said, Cameron, how many people are going to be over that 20 million? Not many, I would assume. I would think. But here's the thing. They always start low.
True.
Like even when they first instituted the income tax, federal income tax, it was only for the super wealthy. At that point, I believe, correct me if you know, Lloyd, but I believe it only affected people that made over $200,000. This was going back to 1913, which.
No, absolutely. In fact, I think the modern day equivalent might have even been closer to $1 million.
Exactly.
When they had to start paying income
taxes.
Taxes.
When you take that into account for inflation, I mean, what that $200,000 would be in 1913 compared to 2021, I would imagine it's more than 5 times. It's probably maybe the equivalent of, I don't know, 1 million or 2 million. But man, I think I might be hitting this too much, but this is where they start. Well, it's just going to be those just a super wealthy.
No, I think I will echo what you said before. I think in one of the first opening bullet points that Lloyd had, it was them implementing a tax at this point, whatever, point that is, and then expanding it. And I think the sentiment that you're making is they're going to set the ceiling here and then bring that down. Right. And couldn't agree with you more.
With me?
They did a similar tactic when they introduced the FICA tax. The idea originally with the FICA tax was it was only going to be employer paid. I believe it was FDR's suggestion that the FICA tax be borne by both the employer and the employee, so that at least the employee would feel like he was getting back his money.
Yeah.
Well, even when they said Social Security would never be taxed when they originally started that, well, we could go. We could do a whole podcast on that. But all right, Lloyd.
Let's move on. Give me something good. Give me a
all right, last one. Last one again, we're going to attack qualified accounts. Backdoor Roth conversions are gone.
Okay.
And that, again, this is something that's still allowed for 2021. So if anybody is contemplating doing a backdoor Roth, now is the time to do it. And basically the way that would work is individuals who are over the limit for contributing to a Roth IRA, they would make a contribution to a traditional IRA, a non-deductible contribution to the IRA, and then convert it into a Roth account. So again, you weren't getting a deduction in the first place. Now you may as well make it that you were getting tax-free returns on that investment.
We're going to talk about some things. Lloyd's going to share about some things that you can do now before the end of the year to take advantage of any, to be proactive with your tax planning. So that'll be in another podcast. But Lloyd, was there anything else you want to add on these tax changes?
Yes. So under the $10 million limit, there's now a new reporting requirement, which some people are not going to like from the privacy perspective. It's that plan administrators must report to the IRS any balances that are in excess of $2.5 million. So if you have a $3 million IRA at Vanguard, you might be under the 10 million still, but believe me, Vanguard's now required to tell the IRS about it.
They got their eye on you. They're making you raise your hand.
Well, Lloyd, I thought they already did on the 5598 or whatever, but there is that.
They do, but not on. Yeah, I shouldn't say IRA. I should say in the 401k, because that's where you actually have a plan administrator versus a custodian. I should rephrase that.
Oh, okay. Interesting. Why would that? Now, the amounts reported on the IRA, if you have an IRA, you will get a form that's sent to the IRS that includes the balance of your IRA. And at least the reason they told us why that was being reported is so they could calculate your required minimum distributions. Okay. Commonly called an RMD. You don't have to take an RMD from 401k money. So that's why those were never reported. But you're saying now, Lloyd, the government wants to know not just what you have in the IRA, but they want to know what you have in the 401k, particularly if it's over $2.5 million.
Exactly. And then the last one is beginning in 2032. So again, we have some ways to go for this. High income taxpayers. And again, that's going to be under the similar numbers than what we've been talking about, are only going to be allowed to roll over IRAs from other only going to be able to roll over to Roth IRAs from other Roth IRAs, as well as designated Roth accounts. That does eliminate Roth conversions for those high income earners.
10-year window. What did you say? 2032?
2030 tax years beginning after December 31st, 2031. So yes, 2032 onwards.
So they're just throwing that out there, right? And just, don't worry about it now. Don't worry about it now, right? It's 10 years away. Not a big deal. Yeah.
Okay, Lloyd.
Now, could this change? Absolutely. But again, the whole entire stock market could liquidate and we'll be going back to the barter system. So, I mean, anything's possible.
Awesome. Lloyd.
Yeah.
Thanks for sharing your expertise. Hold on, because we're going to cut to some more information. But Lloyd, thanks again for being on our show, and go make it a fantastic day.
Take care.